All right, so let's jump into this.
Okay.
Think about like a construction site, with those massive cranes swinging those huge steel beams around, or even just like your local bakery with those ovens, the smell of fresh bread.
Mm.
Ever think about how those businesses actually get a hold of all that expensive equipment?
Yeah.
We're going deep today on equipment leasing.
Right.
It's a lot more interesting than it sounds.
It is. Yeah.
We're looking at this article you sent called Risk Sharing and Embedded Financing Models in the Evolution of Equipment Leasing.
Okay.
It's from the Rate Card. They're an industry publication. So,
Yeah, they are. It's a good one.
so you know how we normally think about a business getting like a bulldozer or something? They need it, go to a lender, get financing, boom, bulldozer's on the job. Lender puts up the money.
Right. Straightforward.
Pretty simple, right?
Well, on the surface, yeah.
Okay.
The traditional model really depends on the lender taking all the risk. Business defaults. Lenders stuck with a bulldozer, good luck repossessing a fleet of them.
Like fitting a square peg in a round hole, so something's got to change. This article mentions this legacy of risk. Sounds kind of ominous.
It is a bit, yeah, that traditional model.
Hmm.
Lenders bearing all the risk. Getting tougher these days, especially with this economy.
Mm-hmm.
Industries like construction, transportation, they're hurting. Those sectors go up and down. Makes those big leases pretty risky.
Makes sense. Lenders are probably getting a little nervous taking on all that risk in such a shaky economy. What's the alternative?
Right. Well, the article mentions this thing called embedded financing. It seems to be getting really popular. What is it exactly?
Think of embedded financing like ultimate convenience for borrowers. Imagine buying that big oven for your bakery. Right there in the purchase, boom, there's a leasing option. No need to go find a separate loan. It's fast, easy, becoming really popular. Click, click, boom, you're pre-approved.
Wow. So that does
Oh, it's
sound
really easy.
really convenient.
Yeah.
But you know what they say, easy come, easy go. Is there a downside for the lenders? Are they really okay with taking on all that risk? You're exactly right. That's the catch the article talks about.
Okay, I knew there had to be one. Tell me more.
Well, for one thing, that fast approval.
Hmm.
It often means less time to really check out the borrower. The article says lenders often don't have as much control over the customer relationship either. Makes managing risk a bit tougher.
Sounds like a classic case of too much of a good thing for lenders. They love the volume, but maybe not the risk that comes with it. Is that where risk sharing comes in? The article makes it seem like the next big thing.
Exactly. Article highlights risk sharing as the answer to these problems. Instead of one lender shouldering the whole loan, they bring in some help. Other lenders, insurers, sometimes even government programs get involved.
Okay, so spreading that risk around makes it a little easier to swallow, especially in those unpredictable industries we talked about. What does this look like in the real world? Let's say I'm just a business owner. Would I even know risk sharing is going on behind the scenes?
You might not know, not directly. Say you're a new company, you make these innovative solar panels. Amazing idea, but for a traditional lender, it'd be a risky investment.
Right.
With risk sharing, that lender might bring in some venture capitalists who love funding green tech, or maybe they team up with a government agency that promotes renewable energy. Lots of options.
So from the business owner's view, it just seems like a normal lease.
Right.
But behind the scenes, it's a whole team effort.
Yeah, exactly. That's one of the best parts. The article points that out. Risk sharing lets lenders be more flexible.
Okay.
They could say yes to loans they might have had to turn down before.
That's a game changer. Opens doors for businesses in those volatile industries. Imagine the innovation we could see. It's not just about avoiding risk, it's about making progress.
Exactly. But the article does point out that it's not all perfect.
Of course not. There's always a catch. What are the downsides?
Well, one of the big concerns is what happens to the relationship between lender and client? With all these extra parties involved, that direct connection can get lost. The article suggests it might mean less personalized service, could even affect trust in the long run.
Like the difference between having a financial advisor who knows you and your business inside and out versus getting a different person on the phone every time you call.
Exactly. And for the lenders, managing all these different agreements adds a lot of complexity. Needs special expertise, a lot more paperwork.
So it's a trade-off. More flexibility, less risk, but potentially more complicated and less personal. It's all about finding that sweet spot. But for our listener who might be saying, this is all fascinating, but I'm not in equipment leasing, why should they care about any of this?
That's the million-dollar question, right? The thing is, equipment leasing, it's like a tiny version of a whole financial world. These changes have ripple effects. They impact the entire economy. Businesses need equipment to innovate, to grow, to create jobs. How they pay for that equipment, that affects all of us.
So it's not just about cranes and ovens, it's about economic growth, about progress. This whole dance between risk and reward, it shapes the world around us.
Absolutely. And the article asks a really interesting question. Will being able to share risk go from being a nice bonus to being absolutely necessary for survival in this changing world?
You mean those who stick with the old ways, that legacy of risk, they might get left behind? Seems like being able to adapt is key in the world of finance. Things are changing so fast.
For sure. The equipment leasing industry is evolving right before our eyes. All this change just shows how much we need new financial models that find that balance between being convenient and being responsible with lending.
It's pretty amazing to see how finance is changing. Maybe this collaboration, this smart risk-taking, maybe that's the key to a stronger, more inclusive economy. Something to think about as we navigate this constantly changing world. So there you have it. Thanks for joining us for this deep dive into the world of equipment leasing. It's way more than just a niche topic. It gives us a glimpse into the forces that are shaping the future of business and finance. So embedded financing sounds incredibly convenient for borrowers, but you know what they say, easy come, easy go. Is there a downside for lenders? Are they totally comfortable taking on all that risk?
You hit the nail on the head. The article suggests that while embedded financing is fantastic for borrowers, it presents a whole new set of challenges for lenders.
Oh, I knew there had to be a catch. Tell me more.
For starters, the quick approval process often means less time for thorough borrower assessments.
Okay.
The article points out that lenders often have less direct control over the customer relationship in this model. It makes managing risk a bit trickier.
It sounds like a classic case of too much of a good thing for lenders. They love the volume, but not necessarily the risk that comes with it.
Right.
Is that where risk sharing comes in?
Yeah,
The article seems to suggest it's the next big thing.
precisely. The article highlights risk sharing as a potential answer to these challenges. Think of it this way. Instead of one lender shouldering the entire weight of a lease, they bring in reinforcements. Other lenders, insurers, even government programs in some cases.
Okay, so spreading the risk around makes it more palatable, especially in those volatile industries we talked about earlier.
Right.
What does this look like in real life? If I'm a business owner, how would I even know risk sharing is happening behind the scenes?
You might not, at least not directly. Let's say you're a startup. You're creating innovative solar panels.
Okay.
A fantastic idea, but a risky investment for a traditional lender.
Right.
With risk sharing, the lender might bring in venture capitalists who specialize in funding green technology, or perhaps they partner with a government agency focused on promoting renewable energy.
Oh, interesting.
Lots of possibilities.
So from the business owner's perspective, it might seem like a regular lease, but there's a whole lot of collaboration happening behind the scenes to make it work.
Exactly. And that's one of the significant advantages highlighted in the article. Risk sharing makes lenders more flexible, allowing them to approve leases they might have otherwise rejected.
This could be a game changer, opening doors for businesses in sectors with inherent volatility. Imagine the innovation it could unlock. It's not just about mitigating risk, it's about fueling progress.
You've got it. But the article also points out that this model isn't without its hurdles.
Okay, so we've got this new model really shaking things up, right? Making things happen that might not have before. But let's be real, no system's perfect. The article did mention some downsides to this risk-sharing model. What are we talking about?
Yeah, so one of the biggest concerns is what it could do to the relationship between the lender and the client. With so many different groups involved, that one-on-one connection, it can get lost. The article even says it could mean less personalized service for the borrowers, maybe even less trust over time.
Yeah, it's like imagine having a financial advisor who knows you and your business like the back of their hand versus, getting a different person every time you call.
Exactly. And on the lender's side, having to manage all these different agreements, it gets complicated. They need people with special expertise just to handle it all. Probably means a ton more paperwork too.
So it's a trade-off then. More flexibility, less risk, but it might be less personal, more complicated. Finding that balance is tricky. But for our listeners out there who are thinking, okay, this is interesting, but I'm not in equipment leasing, why should they care about all of this?
That's the big question, right?
Okay.
Here's the thing. Equipment leasing, it's like this little microcosm of the whole financial world. These changes, they don't just stay in that one area. They have ripple effects. They end up impacting the whole economy. Businesses, they need equipment to grow, to come up with new ideas to create jobs,
Yeah.
and how they pay for that equipment. That matters to everyone.
It's not just about the cranes and the ovens. It's about economic growth. It's about progress.
Yeah,
This whole dance between taking risks and getting rewards that shapes the world we live in.
absolutely. And, the article asks a pretty thought-provoking question.
Mhm.
What if being able to share risk goes from being a nice to have to being absolutely essential for businesses to survive in this changing landscape?
Wow. You mean those who stick to the old ways, that legacy of risk we talked about, they might actually get left behind. It really seems like being able to adapt is crucial in the world of finance these days. Things change so fast.
Definitely. I mean, the equipment leasing industry is literally evolving right in front of us.
Oh.
And all of this change just goes to show how much we need new financial models, ones that can be convenient but also responsible.
It's amazing to watch it happen. Maybe collaboration, maybe smart risk-taking, maybe that's the key to a stronger, more inclusive economy. Something to think about as we all try to navigate this ever-changing world, right? So there you have it. Thanks for joining us for this deep dive into the world of equipment leasing. It's way more than just some niche topic. It gives us a glimpse into the forces that are shaping the future of a business and finance for all of us.